Hello and welcome to Wealthy and Wise. I'm Nadine Blayney from AusBiz. Well, FY26 delivered plenty of surprises. A handful of market darlings stumbled big time. We saw value staging a bit of a comeback, and investors were forced to rethink some long-held assumptions. So what were the defining themes of the year just gone? And what could matter most in FY27? This week on Wealthy and Wise, we look back at the winners and losers of FY26 and ask what investors should be watching next. We, of course, will answer a viewer question as well. First, though, let's add some value. Okay, before we look at individual stocks, I think it's worthwhile stepping back and asking a bigger question. What kind of a market are we entering? In this segment, we'll review some of those defining themes of FY26 and explore the forces most likely to influence returns, valuation, and behavior in FY27. Andrew Coleman from Teaminvest is here to my right, and a very warm welcome to Wealthy and Wise, Sean Hickman from Market Matters. Sean, new blood, so to speak, on this program. Just introduce us to Market Matters and I guess how you would characterize yourselves as investors.
We're definitely bottom-down or bottom-up, top-down investors. So we look at the economic backdrop that lets us know where we want to be overweight or have exposure to in the overall marketplace. And then let's say, for example, we want to belong to the healthcare sector. We think for reasons ABC, healthcare is a good place to be at the moment. And then we look at the individual companies to distill which healthcare stocks we want. So it's like a meeting of the two forwards.
Yeah, well, interesting, because that's not exactly what you're about. So this should be interesting. What was your biggest take from FY26, Sean?
It was a fascinating market. Absolutely. My background is a professional trader for over a decade. So we had a bit of spice around the edges there as well. And one of the things that I think last year told us, FY26, was don't underestimate what the market can do. You know, the elastic bands were stretched in both directions, a lot further than people thought, and at times further than I thought. So we had the AI disruption trade smash stocks like Zeros and Wise Tech, a lot of the Sasaropolis, which I don't say very well.
No,
you know, a lot of the Australian tech names in particular got really, really hit. Whereas, you know, if you look at the Korean market, you'd think we're in the best bull markets ever because of the AI build out. So, you know, there's a lot going on. And the polarization of performance across the ASX 200 was huge. The miners had a great year. Obviously, as I said, tech and healthcare had a very, very bad time. So you've got to be open-minded. You've got to be a bit more nimble, I think, than normal. You've got to be flexible. And it's really, really exciting market. But if you sit there and let the traffic lights get stuck in your eyes, it can be quite scary.
All right, Andrew, you've brought a chart to show us what FY26 returns really looked like in essence. What were your big takeaways from FY26?
Yeah, look, I think the market has an incredible habit of making the best performers one year the worst the next and vice versa. And that's really just as sentiment swings. And we move around. We've joked about it before. You know, anytime you think something is exciting, wait 18 months, either positively or negatively, and the message will flip. If you think about it, we started FY26 with sort of a few key global themes that everyone was talking about on this program and on other programs, which was, you know, everything was going to be technology. SaaS businesses were riding high. You know, Australian SaaS businesses were trading on multiples well over 100 times. It was the Mag 7 in the United States. It was all about the hyperscalers in terms of the owners of software. And then the other two things you couldn't possibly lose in investing when you look back a year ago from every market commentator was health and consumer stuff. Because, you know, interest rates were low and people constantly need medical care. That's not going to change. Well, of course, as is always the case with the market, just when everyone gets euphoric, you can expect the pendulum to swing the other way. And so I think what's really interesting, if you look through FY26 from a sort of long-term lens, it looks no different to any other year. About half of the companies in the index made a gain. About half of the companies.
That's what we're looking at here?
Yeah, absolutely. 101 green, 97 in the red, 3 that were flat. You know, that's pretty normal. It's the problem with investing in indices, which is that you get, you know, a bit of everything. You get the dogs and the unicorns. The chart I think you were showing before was my joke about how if you cut the index in different ways, you can get an entirely different return. So what we were showing there was that, you know, the ASX 200 quoted return for the year was 2.77%. That's on a market cap weighted basis. Remember, one of the big themes at the start of FY26 was the big companies will keep getting bigger. There'd be no point investing in anything else because all the passive money was flowing into the top end of town. Well, it turns out if you look at the same index on an equal weighting basis, you've got about 4 times the return. In other words, the bottom end of the market, as you can see there, outperformed the top end of the market. That's just the way it works.
It does. And that's quite interesting, though, because if you look at the small cap side of things, the Australian small caps are down about 8.8% in FY26, whereas the big caps, or the ASX 200, was up marginally, as you said. Whereas in the US, it was the complete opposite. The US, the small caps were up over 20%, and the big caps were up about 10%. And the difference is their economy is much stronger than ours. That's where you got to boil down. That's why, in overall sweeping broad brush. I mean, broad brush doesn't make you money, but that's how we see it. You look now, I think one thing missing from that chart with the 97,101 was how many stocks were up by or down by more than 40%. Yeah. There was some real ugly ducklings out there.
All right. Well, let's take a look at, I guess, FY26 by sectors as well, because I know that you guys, and we'll talk about it in the next segment, did well out of a lot of the miners. And the material sector did do very well in FY26.
Yeah, I mean, the material sector is made up of more than just miners. There's lots of what you would call old school heavy industrials that fall into materials, people providing other solutions for the material sector. But yeah, I mean, we started the year, as I was joking before, with consumer, health and tech being the big themes. And of course, who were the big losers for FY26? Consumer, health, tech, and a little bit of real estate. And then the big winners were utilities, industrials and materials. In other words, even in a year where we've had some of the most incredible adaptations to world technology that we've seen in a very long time, the businesses that actually made you money on the ASX were the boring ones that print money. Whether they're printing money in coal, gold, utilities, industrials, manufacturing, services, whatever it was, the non-sexy stuff made all the money yet again.
That's no surprise. Boring can be very beautiful, can't it, Sean?
It can. And one of the things we're going to move on to next is what we found the most important part of investing. What do we think the most important thing is? And that's earnings. Earnings, my answer could be cheekily, it depends on your time frame. Because if you're short-term swingers, you're a trader, sentiment is probably the most important thing. If you're looking at interest rates, of course, the macro side of things, we look at that very much about where we want to weight our sectors. But earnings, if you've got a company growing earnings, making money, it's a lot easier to hold the position when it's down 10% than holding a stock that's on a wing and a prayer and down 10%. So, the answer to that question, to my mind, is earnings. You got to focus on earnings. And when the earnings start to dial up on some of these stocks that are a bit unloved, that's when you get the really exciting moves.
And do you look at the macro, did the interest rate environment, would it in FY26? I mean, that obviously mattered a lot when you looked at those real estate stocks as an example. I mean, the macro does matter.
Yeah, I mean, it matters in the short term because it changes. I think in the long term, though, there's a lovely old joke. Everyone watches and wants to talk macro, but you make your money with the micro. In other words, there's lots to talk about that's going on in the world, and it affects companies and it affects our decisions, and it's exciting. But at the end of the day, you don't own the world, and you don't own interest rates, and you don't own a sector unless you really have infinite capital. What you own is individual companies in that. And so what matters in the long run to your returns is how good are the companies you own at navigating a world environment that shifts from positive and negative. And the world environment shifts from positive and negative all the time. Almost certainly when you look through economic data, 2 or 3 up years, you get a down year. So if a company is only good at managing itself in one form of economic environment, it's almost certainly going to end up a capital killer for the investor, because at some point the environment will change and they'll be on the wrong side.
If you don't get out of the trade, right?
Absolutely. And I think that's one of the things we're seeing in the moment, especially in the US, where we're seeing the broadening of the stocks that are going up. Back to the old school, the value stocks are going up. And one of the reasons behind it, to put it in terms of simply the reasons, is the market is now decided, okay, these quality businesses are able to cope with a higher interest rate environment. So we use interest rates, or our view on interest rates, to help us tweak portfolios, but very much so. Companies have to be quality companies making money for us to be in there.
So one of the things I think that is masked by, some of the charts that we were looking at are some of those individual stories. You pointed out in the small cap world, had some big winners. You had some very vicious reactions to disappointments. But those themes and the SaaS apocalypse comes to mind, but also, Defense was a major theme in FY26, likely to continue through FY27 if you look at the state of the world.
I don't agree with that one, by the way.
You don't agree with that?
I think the defense sector, I was talking about it on the show before, I think the defense sector, we sold out and got back into early real estate last year when we thought the market's expectations of interest rates were as good as it can get. Okay, and it was, and we obviously had 3 tightenings this year, and we think things are probably going to, that's it in our opinion now, but that's, it doesn't mean we go heavily overweight real estate, but it means it becomes on our screening, I should say. But when you look at the defense side of things, there's an awful backdrop out there. We've got all the volatility that's come out of the US, as we know. We've had the US-Iran war. We've got the Ukraine war that's ongoing, etc., etc. I hope and pray that's it, and things aren't going to get any worse. The markets look 6 or 12 months ahead. And if things don't get significantly worse, I think we've seen peak buying in defense stocks for a while.
Would you agree?
Yeah, I think it comes back to that comment about wait 18 months. I think the pendulum, so we talked about it before, Sean brought it up. The share price is made up, or any company's share price is made up of 2 things: the earnings of the business and the sentiment attaching to those earnings. In the long run, earnings are predictable. And in the case of the defense stocks, and we did a whole segment on defense, there are some American defense companies with incredibly predictable earnings. And then there are a bunch of other companies out there that move on the trend. In other words, when people get excited about blowing things up, their share price rises. And when people get unexcited about blowing things up, usually because we just blew a whole bunch of stuff up, they come down. So the question becomes, again, in defense, which companies are you referring to? If what we're referring to is Australian defence stocks, I agree. I think they have run incredibly strongly. They're all now on stupid PEs. They don't make a lot of money. Australian listed defence companies are not stable, profitable businesses, the majority of them. I think you're right. In the next 18 months, you will be hurt if you hold them, more likely than not. But if you're talking about someone like Leonardo in Europe, or, BAE in the UK, or you're talking about Northrop Grumman, or, one of the big Americans, no, you're probably fine, because we are blowing up more things.
Yeah. All right. You brought a chart that's the ASX 21 to the ASX 50. What are you looking at here?
I thought it was just an interesting thing. If you looked at that chart before that broke down the various indices on an equal weighted basis to sort of look at where the returns were, the big outlier was the ASX 21 to 50. The ASX 10 and 20 got between 6.7 and 8%. You saw the same in the 100 to the 200. But where we got smacked this year, or where investors got smacked this year, was in those large but not quite largest caps. And there's a good reason for that. So this is just a chart quickly of the returns on those company names. It starts with Fortescue. It ends with GPT. Blue, green, of course, meaning they went up. Red went down. You can see there's a lot of red. And most importantly, to your point before, Sean, a lot of big numbers in red. 26, 69, 58 down. These are huge numbers. So the question that I've then got, and I always like to do, being a bit more considered, researched and rigorous, which is a fancy way of saying nerdy, is to have a look at what drove that. Because you should always look at your a priori assumptions. In other words, what you would have thought if you didn't know anything else. So if we say, I know nothing about who any of those companies are, and I don't know what caused it, because I don't know who they are, there's only one thing that you can test for, really, which is asking, was there mean reversion happening in the market? In other words, simply that point of those that started on a high PE got hurt, and those that started on a low PE benefited. It came back. That's what those tram lines are on the chart. Each of the blue dots is one of those companies in the ASX 21 to 50. And as you can see, the vast majority of their returns are explained by mean reversion. So I think what we had in the ASX 21 to 50 was a very, very toppy market. On the other hand, now a lot of those PEs have been crunched due to, of course, index methodology. They're no longer in the ASX 21 to 50. They're probably in the ASX 150 to 200. But the odds are they'll be winners next year, because if you're now on a PE of 8 or 10, you've got a long way to rise back to the market average. If you started on a PE of 50, as some of them did, well, there's a long way to fall to the market average.
Makes sense?
Oh, totally agree. And some of those stocks that got hammered, as we were saying before, they actually had triple-digit PEs, and suddenly they weren't growing earnings. And that's a bad combination. And even now, some of the growth stocks are still not growing enough to justify some of those earnings. So it's all well and good to say the stocks that performed the worst last year are going to perform the best this year. I think a better caveat is some of them will. Some of them will have really good years, but a few of them still are weak for a reason. And that's where you've got to do your work. If you don't do your work at the end of the day, you might as well go and play darts.
Yeah. All right. Well, look, you guys have set us up nicely for the next segment. Next, we'll put some companies under the microscope and go head to head. As we just learned, the market's themes are one thing. The real test is how they play out at the company level. In this segment, we'll look at three very different businesses and those that performed well in FY26 to see what they can tell us about FY27. Andrew and Sean are still here with me now. So, gentlemen, I thought it would be fun to put some of the big winners of FY26 under the microscope and just see whether we think it can continue this year. And I know that one of the biggest winners, perhaps in your portfolio, you can confirm yes or no, is BHP, which was up by 33%, the big Australian, record highs to end FY26. Will that winning streak continue?
We think it will. I mean, we're still long. I go as far to say this is quite corny in a way. I think the easy money might be in the rearview mirror from last year. You know, it's got copper. It's transformed itself very, very impressively. Miners often sit back and just take the money when the commodities they mine are up and then go and expand at the wrong time, etc. Whereas BHP's been very prudent. Over the last few years, it's moved away from iron ore. It's recognized that iron ore is in decline. It's increased exposure to copper, which of course has a lot of exposure into the AI build out. It's even done some very well-timed moves with silver, or at least so far, because obviously silver had a blow-off last year, or this year I should say, and just when that was happening, it divested out of silver or did a deal which effectively took it out of the silver market. So we're still bullish copper. We still think that it's got some structural tailwinds behind it. I'm a little bit concerned that it's a slightly crowded trade. You won't get many people in this room say copper's overpriced. And that does concern me because we do look at sentiment indicators. So do I think BHP will give another 30+% next year? We are still long. It also gives a nice fully franked yield as well. But no, I don't think it will give you another 30% next year.
What about BHP and the copper thematic? How do you guys get exposure to that?
Well, we don't, is the short answer. Mainly because, as we've talked about before, commodities are by their nature cyclical, and our investing style, as Buffett style, Teaminvest style, long-term value investors, is to try and avoid anything where you can't control the price, because as a result, you can't be virtually certain what earnings will be. Having said that, if you're going to own a miner, I agree BHP is a wonderful company. It's probably the best miner in the world. It sits at the bottom of the cost curve, which is important in mining because you can't control what you can sell your product for. All you can control is what it costs you to produce. So having the lowest cost producer is a moat. And as you can see from, on the screen there, most of the metrics are green, high return on equity, high return on capital, little or no debt, despite its size. I think the interesting thing, though, is I'm just going to pull up a chart here. This is the chart of BHP's PE ratio over time, which, of course, as we've talked about before, is the sentiment question, the proxy for sentiment. And as you can see, sort of between the last mining boom, 2018, 2019, and the end of last year, the market has been particularly, or investors have been particularly in the market, negative on BHP. It's been trading on low teen PE ratios. In fact, last year it ended, 30th of June, on a PE ratio of 13. Now, talking about mean reversion before, it's no surprise, therefore, that having returned to a PE ratio of 18.5, which is not stupidly expensive, but just going from 13 to 18 means a 40-50% return, even if the earnings had been flat. And so I think that, a lot of what you can see in the material sector this year can be explained by it being unloved for a few years on the ASX. Poor returns, low PEs, in people's mind, it's boring, it's old, it's dirty. We don't want dirty anymore. Positive renewables is going to be the way to go. And then suddenly people realize you've got to build the renewables with something. If you're using it and it's dug out of the ground, someone's got to dig it out of the ground. And BHP's returned to a more normal PE ratio. Therefore, what do I think will happen next year, which is I think where you're going from this? I think 18 is probably around right for something like BHP. I don't expect it to have a particularly wonderful or bad year from here. I think that the gains of changing sentiment have happened. Now it's going to be on fundamentals. And BHP is a good company, but, it's been growing its earnings at about 3-4% a year on average for the last decade. That's probably what you'll get out of it.
Okay, so let's totally switch sectors.
So actually, interestingly, we both agreed on a stock,
Yeah.
which from a totally different angle.
Yeah. No, that's why I love this program. All right. 4DX, because that was actually, I think, the best performer on the ASX 200. Company that doesn't make a profit. Company that you know quite well, don't you?
Yeah, I mean, we had Andreas and the team present at our Emerging Wealth Winners Conference. Wonderful piece of technology, of course, around lung imaging and what that can do for the medical space. But I think this is a classic one where the market has run completely ahead of itself on sentiment. I think there's no question that we will be better off as a society if 4DX's technology is globally adopted and improves diagnostic of lung conditions. Many of us will have been touched by people who've suffered from them. This will be wonderful. But can a business that doesn't have any earnings and in fact has less than $6 million of sales, as you can see there last year, making a $35 million loss be worth $2 billion? I think that's market sentiment and hype. I hope they are able to deliver on it because, as I said, I think they're wonderful people and it's a wonderful company. But at some point when they're making money and good profits, it's going to be hard to sustain a market cap that size unless the profits are commensurately large.
And so, Sean, if you missed out on 4DX, you're okay with that?
I couldn't possibly buy it here. It's a $2.6 billion company. It was yesterday. I'm sure it is. It's a very volatile stock, so it might not be today. It might be higher or lower. It's hoping to make, and hope's a big word, hoping to make a profit by FY28. And it says it will have enough money, cash on hand to get it through to that time until it's profitable. That's quite a long way away. It's only forecast to make, I think, $22 million in revenue in FY27. These are small numbers for a $2.6 billion company. So it's re-rated on its FDA approval. Fantastic. As we said before, fantastic company. Everything it's doing is great. But from an investor's point of view, which is what this show is all about, you really, really are. There's a lot of hope there. And even if it becomes a successful business, I can't believe that sentiment will hold the stock up here for the next couple of years. And if you were a trader, you'd still be, take my money, sit back and wait. Yeah. From an investor's point of view, there's absolutely no hurry. You need to see a few more chapters before you even consider it, in my opinion.
All right, so here is an established business, which was also a very solid performer in FY26, which was Woolworths, up by 35%. Can that continue?
Well, I'm going to end my comments with no. But,
and start them.
I have a habit of doing that. I do apologize. Woolworths has bounced from the ACCC investigations into price fixing, or however you want to term it. Misleading pricing, I think, was the right phrase. It reminded me of how the banks bounced after they had their big government investigation. It got oversold. Everyone got very negative if it was going to get hit with big fines, if it was going to have to start reporting how it was pricing. Eventually, we've all got to eat, and it went back, and we had the mean reversion back to a degree of fair value. It's actually getting a bit ahead of itself, one could argue now, because you've got a situation where the market's broadening, the market's buying. It's even, it's buying the retailers, even though the economy is questionable. It's buying the healthcare sector, which is up 18% last month. And it's certainly buying some of the consumer staples in the last couple of weeks. But I didn't like what happened in the week when the ACCC blocked it opening a new store in Kalgoorlie. And it just felt to me, every time government gets involved in a business, it can't be good. It can't be good. So, Woolworths has got some great positive tailwinds from AI integration into its business. It's got so much data. It can use AI for loads of forecasting and pricing. It's really quite exciting how it can use AI. But I feel the government has now thrown into its hat in the ring and saying we are going to be a lot more pedantic where you open stores. And subsequently, its future earnings are harder to predict. And my colleague here might not agree because the government's involved. Mm-hmm. And so to me, after rallying 35% in the last year, I'm going to call this a hold. I think, again, I wouldn't be chasing it at these levels. Good, solid, great business, but I just don't like businesses where governments get involved.
Okay, well, that's one point. And the other point is that it does have costs. It does have a lot of costs and rising costs when you think of employees in particular.
Yeah, I mean, Woolworths is badly run, right? Let's not try and beat around the bush. It used to be incredibly well run. For the last decade, it's been very poorly run. Its return on capital is well under 10%. Its earning stability is all over the shop. In fact, I'll pull up just a quick chart there of the growth of it. Its earnings and sales over the last 10 years. That's not, it's not a dog. It's not losing money and being a capital killer and blowing up your wealth. But that's hardly the chart of the kind of stability of sales and earnings that you would expect from an oligopoly selling a consumer staple. I mean, Woolworths has pricing power. They abuse that pricing power. That's why they're in trouble with the ACCC. And despite having such pricing power, such a dominant market position and taking their consumers for a ride. They still can't make consistently good profits.
And-
That's
and-
embarrassing.
And they've also, by the way, I made a mistake. It was Coles with Kalgoorlie, but it's the same situation.
And I agree with you. The government's going to get more interventionists because they've been taking consumers for a ride. Now, if you're in a business where you're able to take consumers for a ride and you can't make consistent profits, I would be saying as an investor to get out. The question, of course, is why did it have such a good FY26? I think if you remember why it started FY26, that was right about the time Brad Banducci had been on TV, unfortunately with a very poor interview. I feel for him. I don't think he intended that to go as well, and I think it painted him in a particularly poor light. The company's got issues, but that interview went particularly bad. And I think it just started on a very low number, which means it's easy to get a big percentage increase when you start beaten down. But I don't think there's anything in Woolworths as a year in terms of its profits or its sales or its operations that earned that. I think it was just a bounce back.
And they've also had growing population over the last few years too, which is probably going to slow depending on that particular political football.
Well, imagine this. You're in a business, take out Woolworths' name, and I offer you've got effectively an oligopoly. You've got inflation, consumer price inflation that you can pass on. You have a dominant negotiating position with your suppliers. And you have pretty much the strongest moat you could have in the space around brand recognition. And then I would ask you, would you expect to see stable and growing earnings? Everything is there for them except execution. That's the challenge with Woolworths.
All right, so we're not expecting Woolies to be a winner necessarily in FY27. Look, we were going to go through some of the other big movers, but I think we covered it off with defense. M16 or MI6, I think it is. That's just, recent inclusion into the 200. So let's now, while we've got some time up our sleeves, ask for a stock for FY27. You're welcome, viewers. So I might start with you. We've sort of skirted around this, that already in this new financial year, we've seen healthcare really come to the fore. So we've got CSL making good gains after being written off last year. Is this mean reversion or what's happening here, Andrew?
Yeah, I think it's mean reversion. I mean, we've been joking about it all show about, wait 18 months. But look at CSL. Started the year very, very high. Everything was healthcare. Then healthcare fell out of love. CSL didn't help itself with a few announcements, but healthcare fell out of love. CSL retreated all the way down to a PE of about 12 from being up near, sort of 40, 50. Now it's up 35% in a month. That's not the earnings or the value of a business. No business increases its earnings when they're that size, $3 billion in profit by 35% in a month. That's got to be sentiment. The sentiment just shifts. It's like a pendulum. People's emotions, both fear and greed, tend to overcorrect. And I think people were too greedy about CSL. We've spoken about it, and the other healthcare names. Then they've got too scared about healthcare names, and now it's just overcorrecting. So my pick in that space, which is sort of what you've segued into, is ResMed. My logic behind that is that of all of the big healthcare names, it's the only one that doesn't have any operational difficulties. It's continuing to grow at sort of 20% per annum. In fact, if you have a look here, you can see that's its earnings and sales over the last 10 years. That's a wonderful execution chart. It shows management have really taken advantage of their strong moats. It's got a high degree of return on equity and return on capital. And then when we look at sentiment, which is the question before, this is the PE ratio over the last 10 years. So, it enters FY26 on the lowest PE ratio that it's been for a decade. Well, when you're growing at 20% per annum and the sentiment is the most against you that it's been in 10 years, you can bank as a long-term value investor on making good money out of a company like.
Do you reckon ResMed will have a good 27? Better 27.
We recently sold ResMed, I think recently, a few months ago, and recognised everything, that it's a great company. But we felt at that moment in time that we would get a far bigger bang for our buck from Pro Medicus, and it's turned out to be a great short-term play. And it's interesting that I sat down with James and said, maybe we should we're going to sound like traders, but maybe we should go back into ResMed from Pro Medicus because we're 25% ahead of the curve, which is not to be sneezed at when the market goes up 10 or 15% per annum over, in history. But that's the sort of swings we are seeing in sentiment. Yeah. So, if you were looking at the healthcare sector, I think we'll see stocks like Ansell, FPH. I can see them making new highs. Whereas Cochlear had a horrible, I was talking about it earlier, horrible downgrade in April, which got the market sentiment so negative. It was like, hang on, how can you do those two downgrades in like 3 months and then come out with a whole cavalcade of excuses why? I think the stock dropped 45% that day. And I think they probably cleared the decks, and when they do their next earnings update, it'll probably be okay. The market will probably embrace okay, because that's what they're doing in healthcare at the moment. Again, CSL, these stocks are all trading 50% below their valuations or the long-term valuations, but they're not growing like they were. So that's, that's important. Whereas ResMed obviously is still kicking goals operationally. When we were holding up ResMed, it was coming out with good numbers and it was going down. And that was what we were seeing, that the market as a group was selling healthcare. And because we believe from our, macro view, that this broadening that we are seeing across the market will probably last till Christmas and beyond. By definition, healthcare, the last 18% improvement we've seen in healthcare, we think will continue. And by definition, that's when you start looking at other stocks like ResMed again.
All right. Well, there you go. That's Andrew's picks for FY27. I did put you under the pump and asked what your pick was, Sean, and I think it's in the commodity space again.
It is, and I thought if you've done this before to me and you've asked me to pick a stock which I thought would be the best performer of the year, I thought,
I'm not always kind, am I?
No, I did 2 years ago. I picked Samphire, and it was the best top 200 stock that year. But I'm not going to pick a copper stock now because even though we are very bullish copper, it's very owned, and I'm always very, very concerned when stocks are very owned. So I believe that in the coming years we are going to have a real problem with energy. Energy, and Andrew touched on before, coal. You still need these old school energy stocks to help build the new stuff. And we think that what the biggest shortage is actually going to be in uranium, and which I know makes a lot of people go, oh, uranium, especially in Australia where we don't have any nuclear, but the rest of the world is embracing nuclear in a big way. So if I was going to pick a stock which I think can outperform over the next 12 months with a lot of sentiment involved, I hasten to add, I hate to think how Andrew would screen this stock off. I'd be interested actually, but I think Paladin it was trading about $15 only 3 weeks ago. It's now back at below 10. I can easily see that stock at $15, $20. So if you want a stock which I think can double from here in the ASX 200, that's one of them. But it will be a sentiment play. It will be when uranium starts to really start kicking higher, because there's not much uranium out there. You can't just go mine it out the back garden. It's not like lithium where there's plentiful amounts of lithium out there, or coal where, if respective governments let you go and dig it, there's plenty of coal there. It's not the case with uranium. It takes a long, long time to start getting these mines going. And we feel the way that the big US tech companies are starting to open up and they really, really want alternatives for energy, and uranium's one place. I don't feel the market's pricing in how much greater shortage we're going to get of uranium moving forward. So it's a scary play. It's a very aggressive play. I do stress that.
Yeah. Okay. So fair enough. But I do note your comment about sentiment, because also price, like these uranium stocks, if you get a good price lift, overnight, they go gangbusters. And I guess that's what you may not like necessarily about Paladin.
Yeah, I'm using a bit of a blast from the past saying Paladin, because 15 years ago, almost to the day, I was a research analyst at the time, and I was covering Paladin. It was one of the companies I had to cover. So all my information is now 15 years out of date, but in that space, probably still relatively up to date in that case. I mean, look, I'm a big believer in nuclear energy. And I think if we are going to transition to cleaner fuels, nuclear energy from a physics point of view is by far the best option. There are certain concerns socially around the use of...
In Australia, not globally.
Yeah, exactly. Around the use of... Well, even to some extent, they use it, but they still have a fear, an irrational, I think, largely fear. The challenge Paladin has got as a company, of course, and almost all the other Australian uranium plays, is that the majority of their deposits are located in a country that doesn't let you mine them, which is here in Australia. Paladin's, of course, got some in Africa too, so that gives them at least the ability to make some production and some revenue and profit. But the majority of the uranium miners that are listed on the ASX, DPLO, BOSS, etc., even if they've got uranium in situ, and I think they do, the question is going to be, how are they ever going to get it out at a cost and in a time frame that makes sense to an investor? Because at the moment we have a flat out embargo basically on mining it. So I agree with you. I think there will be a sentiment element there. We don't trade sentiment, but it makes sense. It's a rational argument. So I support it. I don't think Paladin's made a profit for the last 10 years though, mainly because again they've got their ore in the wrong spot. It's in the ground.
Namibia.
Take a quick look. Yeah, Namibia. There you go as well.
It's threatening to make a profit. It's
threatening to make a profit.
I think it will very soon. But it's got to make a lot of profit to start justifying the valuation. But again, the leverage it's got to the uranium price right here, right now is very, very strong.
Yeah, and I think what's a 4 billion market cap? That sentiment, not earnings. If you can get the sentiment right, you'll do well. But I think from a long-term investor's point of view, your question, if you were looking at Paladin from a Buffett Teaminvest style approach, would be to say, how can I be virtually certain what the earnings will be 5 or 10 years from now? There's too much uncertainty, therefore I just put it in the 2i basket.
Different strokes for different folks. Look,
There's also not going to be, I stress, sorry, but you wouldn't have a big holding in it because it's got that leverage, it's got that volatility. You don't throw 10% in like we might have in BHP, for example.
yeah, right. Okay, so there's some themes from FY26 and a couple of ideas to take with you into this new financial year. Sean Hickman, Market Matters.
I was the only person that gave a stock for next year, I think.
No.
Why is it ResMed?
Oh, sorry,
Oh, you agreed with me, so you've got 2.
Okay.
All right. Thank you so much for joining the program. Thank you. Stick around. I've got a viewer question for you, Andrew, because, of course, you asked. Well, let's get to our viewer question of the week. If you would like to ask Teaminvest a question, you can send it to us at wealthy@ausbiz.com.au. And this week's question comes from Walter. And he writes, I'd like to get Andrew's view of iShares Global 100 ETF. Is this the best way to get exposure to the Mag 7? He's held it for 2 years. The unit price has increased by about 35%. Would you recommend taking some profit or holding? Information only, not financial advice, Walter. However, we will answer your question because I wonder if it comes in the wake of last week's program when we were discussing, Andrew, a lot of these big US tech companies. Would you get exposure to the Mag 7 via that ETF?
Probably not on the basis that it's a group of 100 largest companies. So from that point of view, if what you're looking for, Walter, is specifically Mag 7 exposure, you can either do it by owning the Mag 7 in your personal capacity, or there are ETFs that specifically do the Mag 7 and don't dilute you with 93 other global companies. I suppose the question is, though, why do you specifically want exposure to the Mag 7 now? And I'd probably refer you to the episode last week where we covered most of the Mag 7 in relation to that. And I think my comments on the Mag 7 would be they are, well, at least 6 of them are wonderful companies. 1, not so much, but 6 of them are wonderful companies. But they are at the moment, them and the semiconductors, the hottest trade in the world. And they are sitting on PE ratios, in other words, market sentiment, that is clearly euphoric relative to their historic trend. So from that point of view, the Buffett Teaminvest style value investor in me says, if you owned it already and you love the thesis, hold on if you want, but I wouldn't be looking to increase exposure to them at those kind of prices. In fact, as we spoke about last week, we've been lightening some of our exposure, particularly with the amount of CapEx and the changes in business model that many of them are going to have to go through if the thesis plays out around AI. And of course, if it doesn't play out, their money they'll burn. So from that point of view, I probably wouldn't be doing either a Mag 7 increase right now or doing it through the Global 100 ETF. Having said that, if you like the idea of just being invested in the biggest Global 100 companies in the world, the iShares Global 100 ETF is quite a cost-effective way of doing it. We would say, why would you want to own the 100 biggest companies in the world? Just because they're biggest doesn't mean they're the best. And if you've got, in the words of Buffett, 20 great ideas, why do you want to dilute it by investing in your 30th or your 40th? So to me, it just seems a little counterintuitive. But obviously, if you've got the exposure and you don't mind it, it's worth doing. I think the question was hold or take profits. I'd say sell. But then that's mainly because I wouldn't own an ETF like that in the first place.
Yeah, well, Walter asked, you answered. Andrew Coleman, Teaminvest, thanks for joining us. Thank you for sending in your question. You too can get a question answered. Wealthy@ausbiz.com.au. Thanks for watching Wealthy and Wise this week. We'll see you in the next.
Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.